Everyone thinks Bitcoin just follows the S&P 500. Stocks go up, Bitcoin goes up. Stocks crash, Bitcoin crashes. But right now, that relationship is starting to break. And if you don't understand why, the next move could completely blindside you. Because what just happened on February 5th, 2026 wasn't correlation, it was carnage. And here's the thing. This isn't the first warning sign, this is the final warning before everything changes. Let me take you back. For years, Bitcoin traded like a high beta tech stock. When the S&P rallied, Bitcoin rallied harder. When stocks sold off, Bitcoin got crushed twice as hard. The 30-day correlation hit 0.88 in early January 2026, meaning they moved almost identically. Bitcoin became just another risk asset in institutional portfolios, another checkbox, another ticker on Bloomberg terminals. Back in 2022, during the Fed's hiking cycle, Bitcoin and the S&P moved in perfect lockstep. Correlation spiked above 0.4 as both assets got hammered by rising rates and inflation fears. Bitcoin fell 64%, while the S&P dropped 18%. Different magnitudes, same direction. The narrative was simple. Bitcoin is digital gold, but it trades like digital tech stocks. And for a while, that made sense. Bitcoin ETFs launched in January 2024. Institutions piled in. BlackRock, Fidelity, institutional flows. Bitcoin became Wall Street's newest toy. When you had billions flowing through spot Bitcoin ETFs in the first months, of course it was going to correlate. Same buyers, same macro drivers, same Federal Reserve watching over everything. The early days were euphoric. In the first 2 trading days of January 2026, Bitcoin ETFs pulled in over $1 billion. Analysts called it resurgent risk appetite. Institutional conviction was back, or so it seemed. Everyone got comfortable with this relationship. Bitcoin was the risk-on proxy, the leverage play on the S&P, the thing you bought when you wanted more juice from the same trade. But comfort breeds complacency. And right now, that complacency is about to get destroyed. Look at what's happening. Bitcoin peaked at $126,000 back in October 2025. Since then, down 52%. Meanwhile, the S&P. So let me ask you something. Why is Bitcoin stalling while stocks push higher? Is Bitcoin seeing something stocks don't? Or is this just a shakeout before the next leg up? Here's another angle. On Thursday, February 5th, Bitcoin crashed 15%. The S&P down barely 1%. That's not correlation, that's decoupling. And it happened again on Tuesday, February 3rd. Bitcoin briefly dipped below $73,000, hitting its lowest level since November 2024. The S&P barely flinched. But wait, there's more. During the same period, Bitcoin broke below its 365-day moving average for the first time since March 2022. According to CryptoQuant, Bitcoin declined 23% in the 83 days following that breakdown, worse than the early 2022 bear phase. And yet, the S&P is still near record highs. Now here's where it gets truly bizarre. Bitcoin has now logged 4 consecutive negative months, the longest losing streak since 2018. January 2026 alone printed roughly 10.57%, marking a 22.3% peak to trough drawdown from the January 14th high of 97,838 to the January 31 low of 75,993. Annualized realized volatility spiked to 43.9%. Meanwhile, what's happening with ETF flows? The narrative flipped fast. After that euphoric $1 billion inflow in the first 2 days of January, we've seen a complete reversal. In the following 3 days alone, Bitcoin ETFs registered net outflows of $128 billion. Year-to-date flows essentially went flat. That early optimism, gone, erased. And it got worse. From November 2025 through January 2026, the spot Bitcoin ETF complex shed approximately $6.18 billion in net capital, the longest sustained outflow streak since these vehicles launched. November saw $3.48 billion in outflows. December added another $1.09 billion. That's $457 billion in just 2 months, the worst 2-month stretch on record. The previous record, February-March 2025, with $432 billion in outflows. Then came January 2026, another $1.61 billion in outflows. On January 29th alone, $817.87 million fled. January 30th, another $509.70 million. These aren't retail panic sells. These are institutions rotating out. So what's going on? Why is Bitcoin falling apart while stocks grind higher? Or is Bitcoin actually right and the S&P is the one living in denial? This is the crack. This is cognitive dissonance. And if you're not paying attention, you're about to miss the biggest regime shift in crypto since 2020. Here's what most people don't understand. Bitcoin doesn't follow the S&P 500. It follows global liquidity, and liquidity moves first. Let me break this down. When central banks inject liquidity into the system through QE, rate cuts, or expanded balance sheets, that liquidity flows into risk assets. Bitcoin, being the most liquid, most global, most decentralized risk asset, reacts immediately. Stocks, they lag. They need earnings, corporate guidance, analyst upgrades. Bitcoin, it just needs one thing, more dollars chasing it. But when liquidity tightens, Bitcoin feels it first. And right now, liquidity is tightening hard. The Federal Reserve held rates at 3.5 to 3.75% at their January 27th to 28 meeting. They're staying restrictive. Their statement maintained the somewhat elevated inflation framing. Inflation is still above target. The market wanted relief. The Fed gave them patience. And what happened? Bitcoin fell from $90,400 to $83,383 within 48 hours, a 7.3% drop. That's acute sensitivity to monetary policy. Now let's talk about what's really happening with global liquidity. Global M2 money supply, the broadest measure of money available for spending, saving, and investing, is growing at just 3 to 4% year over year as of late 2025. That is below the historical healthy range of 5 to 7% that typically matches nominal GDP growth. When M2 grows above 10%, you get inflation warnings. When it goes negative, you get recession warnings. Right now, we're in the tight zone. And here's the critical insight. M2 changes take 12 to 18 months to fully impact inflation and asset prices. The massive 27% surge in M2 during 2020-2021, that predicted the 2022 inflation spike that arrived 18 months later. Now, with M2 growth subdued, Bitcoin is pricing in what's coming 12 to 18 months ahead. The S&P, still pricing in today's earnings. That's the divergence. Look at the data from the top 21 global central banks. Their combined M2 has stabilized but isn't expanding aggressively. The Fed ended quantitative tightening, QT, in December 2025, slowing it from $95 billion per month to just $5 billion per month before stopping entirely. That's a relief, but it's not expansion, it's stabilization. Bitcoin needs expansion to rally. Now here's where it gets really interesting. President Trump just nominated Kevin Warsh as the next Federal Reserve Chair, taking office May 15th, 2026. Warsh is known for favoring a more rules-based framework and potentially lower rates over the medium term. But markets don't believe relief is coming anytime soon. They're pricing in volatility, uncertainty, and pain before any easing cycle begins. And that's the key. Bitcoin isn't reacting to what the Fed is saying. It's reacting to what the market is pricing in global liquidity terms. And right now, the market is pricing in tighter conditions, slower growth, and capital rotation away from high beta assets. Look at the institutional data. US Bitcoin ETFs, which purchased 46,000 BTC this time last year, are now net sellers in 2026. According to CryptoQuant, institutional demand has reversed materially. The average cost basis across US Bitcoin. Meanwhile, the S&P is sitting at nosebleed valuations. The Buffett indicator, total stock market cap to GDP, reached 205% in January 2026. The historical average, 100%. When this ratio exceeds 200%, Warren Buffett has historically called markets strongly overvalued. The S&P's PE ratio climbed to roughly 29x compared to its historical average of 16x. That's a 75% premium above the long-term mean. Gold, meanwhile, extended a record run. Prices pushed above $2,800 per ounce in late January, with some reports showing spikes toward $2,150 before a sharp reversal. That's a defensive rotation. Money is flowing into safety, not risk. So here's the question. Is Bitcoin crashing because it's weak, or is Bitcoin crashing because it's honest, because it's pricing in reality before the S&P does? History gives us clues. In 2019, Bitcoin rallied from $3,000 to $12,000, while stocks barely moved. The correlation went negative. Bitcoin operated independently, driven by its own supply dynamics and adoption trends. Global M2 was expanding, but stocks were range-bound. Bitcoin led. Then in 2020, at the start of COVID, Bitcoin and equities were negatively correlated. But as the Fed flooded the system with liquidity, expanding M2 by 27%, they synchronized. Both assets rocketed higher together. Now, as liquidity tightens, we're seeing the reverse. The correlation is breaking on the downside, and when liquidity eventually re-expands, Bitcoin will break upward while stocks might still be correcting. The key line you need to understand, Bitcoin doesn't follow the S&P 500, it follows global liquidity, and liquidity moves first. So what are institutions doing right now? What are the smart money players watching? First, they're watching volatility. The VIX spiked to 21.44 on February 5th, up 15%. That's the highest volatility reading since April 2025. When volatility rises, correlations tighten short term. Everything sells off together. But long term, high volatility environments create divergence. Assets start moving based on their own fundamentals, not just macro flows. Bitcoin's implied volatility tells an even more interesting story. Option markets showed IV sitting near 40% at the end of January, closer to the lower half of the last year's range than the panic zone. In previous sell-offs, IV spikes towards 60% have lined up with local or intermediate lows in Bitcoin as forced liquidations flushed out leverage. We're not at capitulation yet. Second, they're watching the BTC S&P 500 ratio. This ratio is increasingly used as a signal of portfolio rotation and risk appetite. When the ratio rises, it means Bitcoin is outperforming. Capital is rotating into risk. When it falls, capital is rotating out. Right now, that ratio is collapsing. Bitcoin is underperforming significantly. And that tells you exactly where institutional money is flowing, away from crypto into defensive positions. Third, they're watching cycle positioning. We're in a midterm year of the presidential cycle. Historically, midterm years are the worst for equities. Long strategies succeed only 50% of the time, and historical drawdowns reach 19% to 35%. We're in February 2026. If the cycle holds, we're entering a high volatility window in Q2 and Q3. Bitcoin, being more sensitive to risk, would get hit first and hardest. But here's the flip side. After midterm weakness, markets historically rally hard going into the pre-election and election years. If Bitcoin bottoms first during this midterm weakness, it could lead the next rally. Fourth, they're watching liquidations. Over $2 billion in long and short crypto positions have been liquidated this week alone, according to CoinGlass. Forced liquidations create cascading sell pressure. When traders' positions are automatically sold as Bitcoin hits certain prices, it triggers more selling, which triggers more liquidations. It's a feedback loop, and it's brutal. But liquidations also create opportunity. Once the leverage is flushed, the market can find a genuine bottom. We're in the flushing phase now. Fifth, and this is critical, they're watching Bitcoin's technical structure. Bitcoin broke below its 200-day moving average, currently around $58,000 to $60,000. That's a key support level. It also aligns with Bitcoin's realized price, which is the average cost basis of all Bitcoin holders. If that level breaks, we could see $40,000 to $50,000, according to some analysts. But here's the data point that matters. US Bitcoin ETFs hold about 1.3 million BTC in assets under management, only around 5% below their October 2025 peak of 1.37 million BTC. Despite Bitcoin crashing 40% from its all-time high, institutional holdings have barely budged. That's not panic, that's hodling. Sixth, they're watching macro calendar events. February has 3 scheduled US macro events that could reset everything. February 6th, January jobs report, 8:30 a.m. February 11th, January CPI data. February 18th, January 28th, FOMC minutes release. These releases can reset rate expectations fast. They're the primary volatility catalysts. If inflation comes in hot, expect more pain. If it cools significantly, expect relief rallies. Seventh, they're watching altcoin flows for clues. On February 3rd, while Bitcoin ETFs saw $562 million in inflows, the largest since January 14th, Ethereum ETFs noted $114.74 million in inflows, and Solana ETFs added $19.12 million. That selective strength suggests traders are hunting for value, not fleeing crypto entirely. Now here's what makes this moment so dangerous and so opportunistic. Bitcoin behaves differently at cycle transitions. It gets shaken out first, then it leads. In 2019, Bitcoin rallied from $3,000 to $12,000 while stocks barely moved. In March 2020, Bitcoin crashed to $3,800, then rallied to $69,000 by November 2021, while the S&P had a modest run. Bitcoin leads on the way down, and it leads on the way up. Smart money isn't panicking. They're positioning. They're watching for the moment when Bitcoin stops correlating with the S&P on the downside and starts building its own base. That's the signal. That's when capital rotates back into crypto before the next macro shift. And here's the kicker. On February 2026, Bitcoin ETFs saw $562 million in net inflows, one of the largest single-day inflows since early January. So what does all this mean for you? What should you be watching? What's the actual trade here? First, understand this. If the correlation truly breaks, volatility increases. And volatility is a double-edged sword. It creates risk, but it also creates opportunity. When Bitcoin decouples from the S&P, it means Bitcoin is moving based on its own fundamentals: supply dynamics, halving cycles, adoption curves, regulatory clarity, and liquidity flows. That's when the real alpha lives. Second, Bitcoin can underperform briefly before leading. This is the shakeout phase. We can sell at the bottom. Institutions distribute quietly, retail capitulates. Then, when everyone thinks it's over, Bitcoin finds a floor, builds a base, and rips. We've seen this movie before: 2015, 2018, 2019, 2022, 2023. The setup is the same, the pattern repeats. Historically, Bitcoin has generated double-digit average returns in January, and strength often extends from February through the end of the second quarter. This year, January printed 10.57%. We've now logged 4 consecutive negative months, the longest losing streak since 2018. The last time the market saw 5 or 6 straight down months. The hangover ended in a violent reversal higher once selling pressure exhausted itself. Third, Bitcoin can outperform when stocks stall. Right now, the S&P is sitting at extreme valuations. CAPE ratio at 40, Buffett indicator at 205%, PE at 29x. If stocks correct, and history says midterm years are brutal, where does capital go? Defensive assets, gold, bonds, or Bitcoin? If Bitcoin has already corrected 52% and stocks are just starting to crack, Bitcoin might actually be the safer trade on a risk-adjusted basis. Here's the scenario most people aren't considering. What if Bitcoin bottoms at $60,000, consolidates for a few months, and then rallies to $100,000 plus while the S&P is in a drawdown? What if the decoupling happens in reverse? What if Bitcoin stops following stocks down and starts ignoring stocks on the way up P? That's exactly what happened in 2019. While the S&P was range-bound, Bitcoin went from $3,000 to $12,000. Correlation went negative, and the people who understood that early, they made generational wealth. Now, I'm not saying Bitcoin is about to moon tomorrow. I'm saying the setup is forming. The correlation is breaking. The shakeout is happening. And when this phase ends, the next move will be explosive. Here's what you need to do. 1, stop thinking of Bitcoin as a leveraged S&P 500 trade. It's not. It's a liquidity trade, a supply shock trade, a decentralization trade. Treat it accordingly. Monitor global M2, not just the S&P. 2, watch the $58,000 to $60,000 zone. That's Bitcoin's 200-day moving average and realized price. If it holds, that's your signal. If it breaks, we could see $40,000, $50,000 before the next leg up. But remember, the ETF's average cost basis is $84,099. Institutions are already underwater. How much lower will they let it go before they start buying aggressively? 3, pay attention to global liquidity signals, not just the Fed. Watch the DXY, US dollar index. Watch M2 money supply across major central banks, US, Europe, Japan, China. Watch credit conditions. Bitcoin follows liquidity, and liquidity is more than just interest rates. It's about money supply, credit availability, and capital flows. 4, monitor the February 6th jobs report, February 11th, CPI data, and February 18th in FOMC minutes. These are your volatility catalysts. 5, watch for positive divergence. If Bitcoin holds $60,000 while the S&P breaks down, that's your signal that the decoupling is complete and Bitcoin is ready to lead the next cycle. 6, be patient. This is the phase where weak hands get shaken out, where leverage gets flushed, where conviction gets tested. Analysts at Giottis Exchange noted that ETF flows paint a tactical picture, with periods of inflows followed by modest outflows. This indicates rotation rather than conviction buying. But rotation creates opportunity for those positioned correctly. The people who survive this, they're the ones who position early for the next cycle. The ones who understand that Bitcoin doesn't follow stocks, it follows liquidity. And liquidity leads by 12, 18 months. And finally, remember this. Markets are cyclical. Correlations are not static. What worked for the last 2 years won't work for the next 2 years. The regime is shifting. The correlation is breaking. And the people who adapt, they're the ones who win. One more thing. Smart money is watching for when Bitcoin's RSI, Relative Strength Index, hits oversold levels while institutional flows stop being negative. That's the combo that historically marks bottoms. We're close, very close. So here's my question for you. Do you think the correlation is breaking, or is it coming back? Because if Bitcoin truly decouples from stocks, the next move won't give second chances. The bottom will form quietly. The rally will start without fanfare. And by the time CNBC is talking about it, you'll be late. Drop your thoughts in the comments. Are you buying this dip? Are you waiting for $50,000? Are you rotating out of crypto entirely? Let me know. And if you found this valuable, hit that like button and subscribe to the Wealth Continuum. We're tracking the setup closely. Turn on notifications, because when this thing breaks, I'll be breaking down exactly what it means in real time. Remember, this is the phase where weak hands capitulate and strong hands position for generational wealth. The choice is yours. See you in the next one.